Welcome to the 40th installment in Trading Strategy Guide's Trading Education Series. Today, we're going to check out the RSI indicator. Don't go anywhere. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. In today's video, we're going to discuss the RSI indicator. Now, as with the ATR and the MACD, since this video series is about practical instruction, I'm not going to fill it up with historical and theoretical information. I know some of you are like me and you want to know every single detail that can be known about something, but I also know that a whole bunch of you aren't. So if you want more details about the history of the RSI, Google it, check it out. You'll find everything you want to know right there. As with the MACD, I'll share a bit of how the RSI is calculated though, because it's necessary for you to understand what the indicator is telling you. As always, to satisfy the name geeks out there, RSI stands for Relative Strength Index. Some people use that term, but I just usually say RSI most of the time. I do want to make one thing clear. The Relative Strength Index that we're talking about today is not the same as the relative strength charts that you see that plot the strengths of currencies with respect to other currencies. They are totally different and are used for different things. The RSI is a momentum indicator and displays the strength or weakness of a market based on the closing prices of the recent trading period. As for the calculation, it is simply the absolute value of the current candle close minus the prior candle close. That means that if the candle is green, it's an up candle, and the value is the current close minus the prior close. If the candle is red, it's a down candle, and the value is the prior close minus the current close. The simplest way to do that is to subtract the prior close from the current close and make it a positive number. If that's too mathy for you, that's okay. That's why we have computers. Your takeaway from this is that the RSI is based upon the closing price of each of the candles in the series. Typically, the RSI is used on a 14-day time frame, which for most markets is just shy of 3 weeks' time. It is displayed with a scale of values from 0 to 100 with marks at the 30 and the 70 levels. The 30 and 70 levels are intended to show, respectively, when the market is oversold or overbought, meaning that the market has moved with a lot of momentum and the trader can anticipate a breath in the form of an imminent retracement or reversal. So, used in combination with other indicators and price action signals, the RSI can give you another indication of an impending reversal in the market. Since the market, especially the Forex market, can be overbought or oversold for quite a while before a reversal takes place, some traders will move the 30 and 70 marks up to 20 and 80 or even 90 and 10 to be sure more momentum occurs before the RSI signals a potential reversal. That will help you further filter your trade signals. As I mentioned, I wouldn't use the RSI by itself to find trade signals, since the market can stay overbought or oversold for quite some time. However, like the MACD, the RSI makes a great divergence indicator for finding potential trend reversals. I demonstrated this in the MACD video, but I'll cover it again briefly here using the RSI indicator. A divergence is where an indicator is showing a trend in a different direction than the price action. In other words, the indicator is showing an uptrend when the price action is showing a downtrend. Remember, an uptrend is where the price action or an indicator is making higher highs and higher lows, and a downtrend is where the price or indicator is making lower highs and lower lows. So a divergence is where the RSI trend doesn't agree with the price action. When that happens, it can indicate that the price action is about to change. Here's an example of the daily Australian dollar-US dollar Forex pair. The price action is making higher highs and higher lows, while the RSI indicator is making lower highs. The price hasn't turned quite yet, but it's safe to anticipate a larger pullback or reversal. Here's another example on a 1-hour S&P 500 chart. The price is still pushing up, but the RSI is diverging to the downside, suggesting this might be headed down in the near future. One thing I want to point out is that when I draw the trend lines on the price, I draw the lines from the candle close rather than the high or the low. The reason is that the RSI is calculated from the candle close, so a long wick could skew the trend line. Remember, no signal or strategy is 100% accurate, so this will not work every single time. Don't expect it to. But it does work often enough that you can make a nice profit on this strategy as long as you shut down the losers early and always manage your risk. As I said with the MACD, take some time to study the RSI indicator. See how it reacts with the price action on a bunch of charts and a bunch of different time frames. Spend some time finding divergences and see what the result is. See if it works better on some markets and time frames than it does on others. The more you look at them, the easier they will be for you to find them. And that's it for today's video. Next week we'll look at another indicator that I think is very important, the volume indicator. Come back Friday for my strategy of the week and next Monday for my trade pick. And don't miss the next installment of the Trading Education series next Wednesday when we'll discuss the volume indicator. My videos come out at 3 p.m. New York time on those days. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash the like below, subscribe and hit the bell if you want to be notified of our videos in the future. Have a great Wednesday, and I'll see you on Friday.